In July 1944, 44 nations gathered in New Hampshire to rebuild the global financial order. They created the IMF. They created the World Bank. And then, in Resolution 5 of the Final Act, they voted to dissolve a small bank in Basel, Switzerland, a bank that had just spent the war receiving gold payments from Nazi Germany, including gold looted from the central banks of Belgium and the Netherlands. The resolution passed. Every delegation signed it. The bank was supposed to be liquidated at the earliest possible moment. That was 1944. The bank is still open, and it now writes the rules that govern every bank on Earth. The story everyone knows is that global banking rules come from governments, elected officials, national regulators, parliamentary committees, institutions that answer to someone. But there is one detail that changes everything. The capital rules your bank operates under today were not written by any government. They were written by a committee housed inside an institution that cannot be audited, cannot be taxed, cannot be searched under Swiss law, and was never chosen by any electorate on Earth. This is not a story about a bank that survived World War II. It is a story about who writes the rules of money and who they answer to. The BIS, the Bank for International Settlements, opened for business on May 17, 1930, in Basel, Switzerland. Its founding purpose was specific and technical: manage the transfer of German war reparation payments under the Young Plan, the agreement that restructured Germany's obligations after the Treaty of Versailles. The architects of that arrangement included J.P. Morgan's Bank, the Bank of England under Governor Montagu Norman, and Hjalmar Schacht, the president of the German Reichsbank, the man who would serve as Hitler's economics minister and the primary architect of Nazi rearmament financing. These were the people who built the BIS. From the moment Germany's reparations payments collapsed in 1931, the BIS's original mandate evaporated. But the institution did not. It pivoted to providing banking services for central banks, holding gold accounts, facilitating transfers, maintaining relationships across borders that governments could no longer maintain directly. That institutional flexibility is what kept it alive through the 1930s. And it is what made the events of March 1939 possible. When German troops occupied Prague, the Czechoslovak National Bank held part of its gold reserves in a BIS account at the Bank of England. Days after the occupation, a transfer order arrived, moved the Czech gold to a Reichsbank account. The BIS honored it. The transfer order, it later emerged, had been issued under duress. The gold moved anyway. That is documented in BIS's own historical archive. Throughout the war, the BIS continued receiving interest payments from the Reichsbank on investments it had made in German bonds in 1930 and 1931. The largest portion of those payments came in gold. After the war, Allied investigations confirmed that 3.7 tons of gold the BIS received from the Reichsbank had been looted from the central banks of Belgium and the Netherlands, melted down at the Prussian Mint to obscure its origin. The BIS cooperated with post-war investigators and returned those 3.7 tons to the Allied Tripartite Commission in 1948. The restitution is documented, so is the original transfer. This is the context in which Resolution 5 was passed at Bretton Woods on July 22, 1944. 44 nations, every signature on the final act. The resolution called for liquidation of the BIS at the earliest possible moment. Henry Morgenthau, the U.S. Treasury Secretary and conference chairman, supported it. The reasoning was straightforward. The new IMF and World Bank would handle post-war monetary cooperation. The BIS had spent the war in proximity to the Nazi financial system. It had no legitimate post-war role. But European central bankers, the same governors who sat on the BIS board, lobbied against the resolution. By early 1948, it had been quietly set aside. No new vote, no formal reversal. The resolution simply stopped being acted upon. The BIS refocused on European monetary matters and continued operating. 44 nations voted to end it. It survived anyway. That outcome required active decisions by specific people in specific rooms, which means the question is not how it survived. The question is what it was worth preserving, and for whom. By 1948, the BIS had survived. By the 1960s, it was indispensable. The institution had quietly become the primary meeting point for central bank governors. the place where the people who controlled the world's reserve currencies could talk to each other outside the reach of their own governments. That function hardened into formal structure in the 1970s. The BIS began hosting what it now calls the Global Economy Meeting. The governors of the most powerful central banks on Earth, the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, and roughly 30 others, meet in Basel every 2 months. The agenda is not published. The minutes are never released. The decisions are not subject to review by any parliament, any court, or any electorate. Note what that means in practice. The people who set interest rates for the dollar, the euro, the pound, and the yen sit in the same room every 60 days and discuss the global economy and monetary policy in a forum that produces no public record. What emerges is a communiqué, a short summary statement. Not minutes, not a transcript, a summary. The room exists. The conversations happen. The record stops there. The legal protection is written, not informal. The 1987 Headquarters Agreement grants the BIS full sovereign immunity. Its premises cannot be searched. Its assets cannot be seized. Its staff travel on BIS-issued documents rather than national ones. That is not a privilege. It is the condition under which the rules get written. Compare that to how the European Union writes financial rules. A single EU directive requires treaty negotiation, proposal by the European Commission, approval by the European Parliament, ratification by the Council, and transposition into national law by each member state. Multiple elected bodies, multiple points where the process is visible and contestable. Basel III, the capital framework governing every internationally active bank on the planet, required a committee communiqué from a body housed inside the BIS, the same binding force. An entirely different accountability structure. That contrast is not incidental. It is the design. The mechanism is this. The GEM produces the consensus. The consensus becomes the standard, and the standard becomes binding on every country that wants access to the global financial system. No country is forced to adopt Basel standards at gunpoint, but a bank operating in a country that rejects them cannot clear transactions through correspondent banks that do follow them. The global financial plumbing requires compliance. Rejection is theoretical. In practice, BIS standards function as global law, written by a committee that meets in secret, housed in an institution no government can audit, ratified by no one. Think of it as a committee that has never faced an election writing the speed limits every road on Earth must enforce, from a building no traffic authority can enter. The BIS publishes this openly. The meeting schedule is on their website. The sovereignty clauses are in the 1987 Headquarters Agreement, available as a PDF. They have never needed to hide the structure. The structure was never supposed to be the scandal. It was supposed to be the solution. A neutral space above national politics where technical experts could coordinate without interference. That framing held for decades. Then Basel II arrived. Basel I arrived in 1988. The Basel Committee on Banking Supervision, a committee housed inside the BIS, staffed by central bank officials accountable to no electorate, published a framework setting minimum capital requirements for internationally active banks. Banks must hold a minimum percentage of capital against their assets. The riskier the asset, the more capital required as a buffer. Within a decade, it had been adopted across more than 100 countries. No treaty, no ratification, a committee document, and then global compliance. But Basel I treated broad categories of assets as equivalent. A loan to a stable government counted the same as a loan to a volatile one, if they shared the same crude risk category. Banks began optimizing around the categories rather than the underlying risk. The framework designed to constrain risk instead created a map of how to route around it. So in 2004, the Basel Committee published Basel II, which was supposed to fix that. Basel II introduced sophisticated risk weighting. Banks could now use their own internal models to calculate how much capital they needed to hold against a given asset. The logic was that the banks themselves understood their own risk better than any regulator could. The result was that banks held dramatically less capital against assets their own models rated as safe, assets like mortgage-backed securities. By 2008, the capital buffers were gone, the models were wrong, and the losses were socialized across every economy connected to the global financial system. Note the sequencing. Basel I created the optimization incentive. Basel II formalized it. The institution that designed both frameworks then convened to write the post-crisis response. Basel III, published in stages between 2010 and 2017, finalized in December 2017 by the group of central bank governors and heads of supervision, the BIS's own oversight body, tightened capital requirements, introduced liquidity coverage ratios, and added leverage constraints. It was endorsed on December 7, 2017. No parliament voted on it. No electorate ratified it. The same institution that produced the framework that contributed to the crisis wrote the framework meant to correct it. Basel II was the fix for Basel I. Basel III was the fix for Basel II. Each fix was written by the same room. The pattern is not incompetence. It is continuity. Consider the scale of what a single line in a Basel document actually governs. Basel III's capital adequacy rules apply to every internationally active bank. That means the minimum capital a bank in Warsaw must hold against a commercial loan, the liquidity buffer a bank in Sao Paulo must carry, the leverage limit a bank in Tokyo must not exceed. All of it flows from standards set by a committee that meets inside a building no government can enter. One document determines the risk architecture of the global banking system. The people who wrote it were not elected. The institution that houses them cannot be audited. The process that produced the document left no public transcript. The EU's equivalent process, a single binding financial directive, requires the European Commission, the European Parliament, the Council, and 27 national legislatures. Basel III required the GHOS to sign a communique. Infrastructure is harder to repeal than a rulebook, and what the BIS is building right now is not a rulebook. The Basel Accords governed what banks could hold. What the BIS is building now governs how money moves. That is a different order of infrastructure entirely. The BIS Innovation Hub opened its first center in 2019. It now operates out of London, Singapore, Frankfurt, Stockholm, Toronto, and Hong Kong. Each center runs in collaboration with a local central bank, the Bank of England, the Monetary Authority of Singapore, the ECB, the Bank of Canada. Each one is covered by a host country agreement granting the BIS the same sovereign immunity protections it holds in Basel. The Innovation Hub is not an advisory body. It is a technical development operation. It builds things. The most consequential thing it has built so far is Project mBridge. Started in 2021, mBridge is a live cross-border payment platform built on a purpose-built blockchain called the mBridge Ledger. The founding participants are the BIS Innovation Hub, the Hong Kong Monetary Authority, the Bank of Thailand, the Central Bank of the United Arab Emirates, and the Digital Currency Institute of the People's Bank of China. The Saudi Central Bank joined in 2024. In mid-2024, the platform reached what the BIS called minimum viable product stage, meaning it is capable of processing real value transactions across borders in real time using central bank digital currencies. Now consider what mBridge actually is. It is not a research paper. It is not a pilot in a sandbox. It is a functioning cross-border payments platform built by an institution that operates outside the jurisdiction of any national government, designed to move central bank digital money between countries in real time. As of the end of 2024, 85 of the 93 central banks surveyed by the BIS, that is 91%, were actively exploring either a retail or wholesale CBDC. The BIS is not observing that transition. It is coordinating the infrastructure underneath it. The mechanism is this. The same institution that wrote the capital rules your bank operates under today is now building the rails that programmable digital money will run on tomorrow. Infrastructure is not neutral. The entity that designs the plumbing determines what can flow through it, at what speed, under what conditions, and with what embedded controls. The BIS has never been audited. No government can search its premises. No electorate chose it. And it is building the architecture for the next global monetary system. Augustine Carstens, the BIS general manager, stated publicly in October 2024, mBridge is not the BRICS bridge. Then the BIS handed the platform to its partner central banks and stepped back. The platform has settled over $55 billion in transactions. China's digital yuan accounts for approximately 95% of settlement volume. The project did not end. The ledger remains. Ask who governs the institution building this. The answer has not changed since 1930. The BIS published everything described in this video. The founding charter, the sovereign immunity clauses, the Basel III framework, the Enbridge project page, the CBDC survey. None of it was hidden. It was never supposed to need hiding. The assumption was that no one would ask who wrote the rules, or whether the writers answered to anyone. The most consequential financial rules in your life were written in a building no government can enter, by people no electorate chose. That is not an exception to the system. The dissolution was recommended in 1944. Nobody acted on it.